Hi, my name is Nate. Welcome to the DivMan channel. Today, I want to talk about the best way and maybe the worst way to invest in leveraged ETFs. Now, on this channel, we mainly focus on dividend investing. The stock or the ETF, I should say, we're going to focus on does pay a dividend, and it's not a bad dividend by any means. I believe it's quarterly. But I want to talk about first what is leverage, what is the best way to invest in a leveraged ETF, the pros and cons and that sort of thing. This is the ETF I'm mainly discussing here. It's TQQQ. Now, a lot of people feel that leverage is very dangerous, and that's definitely true. Leverage is, in essence, you take $1 and you multiply its effects both on the upside and the downside by some factor. Now, in this case, TQQQ aims to be 3 times the price movement of QQQ, or the NASDAQ 100 index. Now, when it comes to using leverage, you can have anything from this guy right here who is up 95% in TQQ last year. He said he started with 50,000. And looks like he says it's up to 4 million. Now, that's the cool thing about leverage is each time a particular fund compounds, first of all, it's compounding a certain factor times the underlying, so in this case QQQ, and so TQQ is multiplying whatever QQQ does, at least in theory, times 3. Now, there are 2x, 1.5x leverage funds you can do, but this does not tend to be everyone's experience. Here is another post from the same Reddit forum, and this guy says he's got $18,000 in, looks like Canadian money, but 18,000 in Canadian dollars, down 32% in less than 4.5 months. This gives rise to statements like this from the Wall Street Journal, where they say things like, ProShares, UltraPro, QQQ, a 27 billion behemoth that promises to triple the daily return of the NASDAQ 100 has barely generated any return over the past 3 years as the technology-heavy index has soared. This is a little bit of tricky wordplay here. It's not quite the case that that this fund has just sat around. So let me show you the chart. Let me show you what they're doing here. Here is the TQQQ starting date range beginning is actually this is going to be do 01. Let's see, 01. So this is going to be 2022 to 2025. So that's 3 years. And as you can see, the person who's writing in the Wall Street Journal is measuring almost exactly at the top of the bear market that started in 2022. So it's not quite a fair comparison, because really what's happened in that time is QQQ had 3 times the loss of QQQ, and then it finally is really back up to a positive level from the 2022 level. So given the fact that you can see this kind of insanity when it comes to price movements with leverage fund, what is the best way to avoid, a situation where, I mean, you can't completely avoid this, but there is a general way you can avoid it, just a general strategy, and you should probably, apply some general principles of wisdom to this, but just to show the difference, I'm going to do some back tests to show you what some particular starting positions look like, and then just try to show that the best strategy is the following. So here is just like a a complete, like, you're starting with your traditional 10K of starting principal. You're just dumping money into the fund in a single day or something like that. And then we also are going to add $100 per month, and this is starting in January of 2022, and we're using TQQQ, so the 3x QQQ. We're also using QQQ, which is just 1x whatever the price movement of the NASDAQ 100, that is what it moves. All right, so here is the results. As you can see, it looks like, just TQQQ takes a complete beating from, the beginning of our time here in the beginning of 2022 until about January of 2023, when the market starts to rise. And about July of last year of 24, it jumped above the returns of QQQ for a similar strategy. And then it dumped again, because what happened at the end of July? The market dumped, right? And so you can see here it has trouble catching back up when there's a serious market downturn. Now, if you have any kind of serious money in these funds, you're going to see those kinds of losses. But there is a way to avoid it. So here's the example here of a different strategy where you just start with a small principal of $100, and then you dollar cost average. So we're just using $100 a month, and we're just adding $100 every month, and see the difference between the returns here. So as you can see, they're both pretty much, keeping up with each other until October of 2023, and that's when TQQQ, just the compounding effects of the bull run that began at the end of 2023, you just really see the evidence of it. And so this is the dollar cost average strategy that comes with TQQQ. And so you see it jumped up to about 8,000 here in July of 24. It dumped again, but still above QQQ to 5,000. And this is just $100 a month. That's all we've done for this strategy in both QQQ and TQQQ. And so it dumped here, and now it's back up to above 8,000. Looks like the total return here is, we started with $100 a month in DCA, and the total value is 8,000 as opposed to QQQ, which is 5,000. And so the annual returns here, as you can see, between TQQ, the leverage version, down 80% in 2022, 2023 up almost 200%, 2024 58%, likewise QQQ 30%, 54, 25. Now this also works with other leverage funds. So here you see, here's VOO. This is the pretty much the lowest fee S&P 500 fund. So they don't charge you that much to hold the fund. And then here's UPRO. This is 3 times whatever VOO does, pretty much. And this is the, I didn't do cash flow. Let's do cash flow. We'll do 10,000 initial, and we'll do $100 monthly. And here's what it looks like for this. So as you can see, complete dump in 2022, and then starting around April of 2023, it starts to regain its position. Now, if you hold long enough, I assume, I don't really have a major reason for this other than just if we have more bull days and more bull runs than we have bear days, most likely these leverage funds will take over, just as you see here. No real major change in the strategy, it's just the compounding effect eventually does overtake VOO. So what do you do if you do the DCA strategy? Here's the DCA strategy. Same time frame, starting in 2022. This is VOO versus UPRO, except we're starting with only 100 and adding 100 monthly. And so this is what we have. Same situation as the let's see here. Same situation as TQQQ versus QQQ. We have around October of 23. That's really when they stop being neck and neck for both QQQ and VOO. And in this instance, UPRO ends up just compounding extremely. Now, QQQ tends to, in its bull run, be a little more, compounding. It increases at a higher rate than the S&P 500. So as you can see, the total return of both VOO and UPRO for the DCA strategy is less than the total return of QQQ and TQQQ. Actually, it looks like, in this case, the underlying QQQ 5,300. In this case, VOO 4,900. So this is typically the best strategy if you are going to invest in a leveraged fund like this, is to DCA. Don't dump money hoping to throw it into the slot machine. Now, maybe you'll get lucky. Maybe you'll just ride the thing on its way up. That's the way a lot of the MSTR leverage funds were doing this year. You could just dump money in at the start and you got a lot of money. It was almost unbelievable how much it was compounding. But in addition to that, it does pay a little bit of a dividend for TQQQ. In this case, it looks like it paid, about 20 to 30 cents ish. And then in the case of UPRO, pays something similar, 20-ish cents per quarter. So you do get a little bit of yield out of this leverage fund. And one other strategy you could use, if you're investing in something like Roundhill, QDTE that follows NASDAQ 100 and they're doing covered calls, or XDTE that's following the S&P 500, you could put some of your dividends into, a fund like TQQQ. Maybe 2% of your dividend, or maybe one dividend out of the year goes into a fund like this. Just whatever your strategy happens to be, put some allocation into this. Set up an allocation of your portfolio, whether it be a brokerage account or whether it be a retirement account that's more risk prone like this. And that way you can sort of maximize your total return for your dividend funds, because with covered call ETFs, usually you're losing out in some of the upside of the underlying. So XDTE, QDTE, they happen to be beating their underlyings as of late, but mostly because of some recent downturns. And so they're beating them on the way down and then sort of holding their own on the way up a little bit as well. So at least with these, if you use some of your yield with your high yield funds to put it in here, you can at least capture more of the upside of the underlying. And with leverage, you don't have to have as much capital in the underlying to capture as much of the upside. So hope that made sense. If you do have any questions or comments, feel free to leave them in the comment section. Also, if you have like a subject that you'd like to discuss, with a video, a back test, or just a discussion of how a fund works or something like that, feel free to do that. Please also like and subscribe if this was helpful. Thanks so much for your time. Bye.